Hi, I'm Sean Alaban with Code Accounting, and we help small and medium-sized businesses prepare their tax returns and complete their financial statements. I'm here to help you choose an entity structure today. Most business owners choose their entity structure the same way they choose their Netflix shows. They'll scroll through their options, choose something that looks good, and hope for the best. But that can cost you thousands in taxes and even your house if you get sued. So let me break it down for you why all of this matters. First, it is important for your legal liability. You want to make sure that you protect yourself and your assets as much as possible. The second reason is because it affects how you're taxed. Different entity structures can change your tax bill at the end of the year, and so it's important you get that right to save a ton of money in taxes. This can also affect your future flexibility, meaning whether you can add partners, raise funds, issue stock, or bring on investors later. The number one mistake that I see founders make on entity structure is thinking that they can set it and forget it. They think that they're stuck with their entity structure even as they grow their entity. And that usually means that they're paying self-employment tax on every single dollar that they earn. That's why I encourage founders to pay attention to the Goldilocks Zone. This is a sweet spot where you want to convert from LLC to S-Corp. And this is generally around the $100,000 in net income mark, because you'll literally save thousands of dollars a year in self-employment taxes. So starting off with the different entity types, sole proprietorship is essentially the default in the business world. This is when you don't really file any paperwork and you just start selling things as yourself. This income is going to be reported on Schedule C of your personal tax return. Every dollar is going to be subject to self-employment taxes, and you receive no limited liability protection from this entity. This is great for freelancers, people who are testing out a business idea, or a trial period to see if their business works. One of the problems with the sole proprietor structure is the legal liability risk that it presents. If you get sued by one of your customers, then all of your assets are at risk. And that's why this is not a good entity structure if you're in a risky industry, such as construction or consumer packaged goods, things that can easily be litigated. You want to avoid this structure. One misconception is that registering a DBA for this sole proprietorship somehow creates a special entity. It does not. It's still your sole proprietorship operating under this DBA that you registered. So no legal liability protection is afforded, and there is no change to your tax reporting structure. The second most common entity structure is LLC. And the LLC is great because it provides you the legal liability protection that the sole proprietorship is missing. So if someone sues your LLC, the damages are isolated to only the assets held by the LLC. They're not going to be coming after you personally. And that's why this is fantastic for real estate. By setting up LLCs for each of your properties, you are isolating them into silos of legal liability. So if someone sues you on one property, they can't get at your other property. The downside of owning an LLC is the cost. At least in California, there's an $800 minimum franchise tax that you'll need to pay every year. There's also an LLC fee that needs to be paid if your gross receipts exceed $250,000 per year. Those additional filings, in California, it's a Form 568 that needs to be filed every year, and the additional taxes that need to be paid make this entity structure a little bit more burdensome and expensive, but for many people, it's still worth it to protect their assets. LLC is also very good for consultants and freelancers operating in a high-risk industry. The LLC structure can become a problem when net income, so your take-home amount each year, over $50,000. Your self-employment taxes are going to be a lot. But if it gets over $100,000, you're in a position where it's better to organize as an S-Corp. You're going to be paying a lot of money in self-employment taxes. It's 15.3% on top of the income taxes that you're paying. And so your effective tax rate really skyrockets when you're earning above $50,000 through an LLC. The biggest mistake that people make with LLCs is mixing their business expenses and income with their personal transactions. And you want to keep everything completely separate. The LLC is a separate entity from you as an individual. And in my opinion, that warrants a separate bank account. Also a separate credit card if you're using credit cards. So you may want to set up separate accounts to make this easier. If you're using the same bank account, then you'll want to make it very clear which transactions are for the LLC and which transactions are for you personally. The next option for your entity structure is the S corporation. This is what a lot of entities graduate to after the LLC because it can save you a significant amount of money on your self-employment taxes. As previously mentioned, when you cross about $100,000 in net income, you'll want to convert to the S-Corp entity classification because the earnings from the business are not subject to self-employment taxes. The caveat there is you'll need to pay yourself a reasonable salary for the services that you provide to the corporation. So you're now setting up a payroll system and issuing yourself a market rate salary for the services that you provide to your own company. And that's why you need to wait until you cross 100,000 because many jobs are, roughly 80,000 a year, 60,000 a year, 100,000 a year. And so until you get over 100,000, you may not be exceeding your reasonable salary. And therefore you're not saving any money because you're still paying the employment taxes on your salary. Once your net income exceeds the reasonable compensation that you need to pay yourself, you will no longer be paying self-employment taxes on the earnings that exceed your reasonable compensation. There's a couple of ways that you can set up an S corporation. First, the S corporation is not a structure that you form, it's a structure that you elect. So you would first register a C corporation and then elect to be treated as an S corporation. You can also have an LLC that elects to be treated as an S corporation. So you're starting off with a different entity structure and then electing the S-Corp status. You can also revoke the S-Corp status at a certain point. One downside to the S-Corp structure is the additional tax return that you're going to file. This is a completely separate entity for tax purposes, and there's a form 1120S that needs to be filed at the federal level, and usually a form that needs to be filed at the state level as well. In the state of California, it's form 100S. So you're going to be filing a personal tax return for yourself and a corporate tax return for your S-Corp. On that S-Corp tax return, there is a form K1, which reports all of your personal income from that corporation, and that needs to be included on your personal tax filing. One example of how this might work is with a consultant that's earning $160,000 a year. They might pay themselves a reasonable compensation salary of $100,000 for the work that they perform for the S corporation. And then the remaining $60,000 of S corp earnings will not be subject to self-employment or employment taxes. That saves them 15.3% on $60,000 or about $9,000 a year by making the switch to S corp. Keep in mind that S-Corp tax returns have a different filing date than your personal tax return. You'll need to file and pay all taxes by March 15th instead of the April 15th for your personal tax return. Another great entity structure, at least in the right situation, is the C-Corp. C-Corps are great for high-growth startups, for startups that are looking for investor capital, and for anyone that really wants to invest in the growth of the business without taking out a lot of funds for themselves. The C corporation is its own legal entity that is completely separate from the individual owner. Nothing passes through. This is important for losses because the losses actually build up over time. If you lose money with a C corporation, it carries forward to future years. And then when you earn profits, the carry forward losses offset those profits, and you don't need to pay taxes right away because of the offsetting losses. So that's great when you're investing in the company and building up the company's value over time. It also gives investors more confidence when investing because they know that any losses that they're incurring are building up for later use and they're still getting a tax benefit. It's not going to leave the company. One of the really fantastic things about the C-Corp entity structure is what's known as QSBS, Qualified Small Business Stock. If you qualify as a qualified small business and you issue stock and you hold that stock for 5 years, then you will get a $10 million exclusion from your gain when selling the business. To qualify for QSBS treatment, the corporation needs to be structured as a C corporation. The total gross assets when the stock is issued needs to be less than $75 million. The capital needs to be deployed at least 80% in your active trader business. And you cannot be part of certain trades, things like law, accounting, consulting. So unfortunately, those do not qualify for that treatment. But a lot of tech companies, a lot of startups will qualify for this treatment. That's what makes it extremely desirable for investors to invest in these companies because they know that a large portion of the gain on their increase in value can be excluded from their tax return. And that's a great tax benefit for investors. There are a few bad things about owning a C corporation. One is the additional administrative burden. You're going to be setting up separate policies for everything. A lot of times you're registering in Delaware for their more favorable treatment of corporations and corporate law cases. And that requires you to register in Delaware, file annual reports in Delaware, and pay annual taxes to Delaware. There's also a double taxation on C corporations. So that means when you earn income from your C corporation and there's not any offsetting carry forward losses, then you're going to pay 21% federal tax on that income. And then if those earnings are distributed to the owners through dividends, there's going to be another taxation of that income as dividend income on your personal tax return. So that's what people refer to when they talk about double taxation on C corporations. And it's definitely a concern if you're going to be pulling money out of the corporation. One misconception that people have about C corporations is that they think they need to be organized as a C corporation to get certain deductions. It's true that deductions vary across entity types, but not significantly. Most of the deductions available to LLCs will be available to C corporations. One notable variance is health insurance, where C corporations can deduct health insurance in full. Owners of S corporations, for example, need to report those health insurance payments as income. There are a couple of key recommendations that I can make when organizing your business. First is based on income. If your earnings are less than 100,000 and you're in a low risk environment, then sole proprietor is best. If you're high risk or there's any chance of you getting sued, then LLC would be better. Once you exceed $100,000 in earnings and up to about $2 million in earnings, you would want to be organized as an S-Corp to save money on self-employment taxes. And then above $2 million, or if you're investing heavily in future growth, then you would want to be structured as a C corporation so that you can take on additional investment and scale the company faster. You can also look at it based on your plans for future growth. If you want to scale quickly and bring on investors, then it's C corporation. If you want a simple structure that protects you legally, you want an LLC. And if you want to save money on taxes beyond $100,000 of earnings, then S-Corp is the way to go. The general recommendation, if you're completely unsure, would be to start as an LLC and switch to an S-Corp when your earnings go over $100,000. That's generally the best option for most business owners just starting out. You'll want to revisit your entity structure when certain things happen. One event might be that your profits have increased to a threshold where an S-Corp makes sense. When your risk increases or you purchase risky assets, that might be a reason to organize as an LLC to protect your assets. Bringing on investors, and at that point, you may want to have the C-Corp entity structure to facilitate those investments. Changing your legal entity is messy. It's much easier to change your tax status. So start off with flexibility, simplicity, and then revisit your structure later as needed. If you want help, reach out to me and let me know. It's important that you get this right because the correct entity structure can save you years of hassle and thousands of dollars in taxes. I'm really looking forward to hearing from you and helping your business succeed.